Yes, there is absolutely a way to grow your portfolio with the markets and also guarantee at no cost that you will avoid any market losses. What's up, you guys? Welcome back to the Average Joe Investor channel. I don't blame you if you're skeptical about this idea. I would have been at first, but the reality is there absolutely is a way to do this. Oftentimes you see this type of advertising, grow with the markets and also a cap on losses or no losses at all. You see this in ads or marketing for annuities that are there to be purchased or potentially certain variations of life insurance. But the truth is you don't need to buy those and all the expensive fees that go along with it. You can do this yourself, and it only takes, maybe 5 to 10 minutes of your time every single year. So what we'll do with this video is I will explain to you exactly how it works. We'll look at an example, a historical example to show just how well it works. Then we'll look at some different examples of how you can do this right now, today, in a major market index. We're here on the Option Alpha website, and we're looking at a specific strategy called a collared strategy. It involves utilizing options, but in a very straightforward way that combines a long stock option, or ETF for that matter, an out-of-the-money covered call, and an out-of-the-money protective put. So really quick, let's define those terms. Long exposure or ownership of a stock or ETF. This just means that you own shares of the S&P 500, the NASDAQ 100, the Russell 2000, any type of ETF or individual stock this can be accomplished with, though it is much more straightforward if you own a single indexed ETF. Next, we talked about a covered call and a protective put. Now, these relate to certain types of options strategies, but they are very simple and straightforward. Let's start with a protective put option. Essentially, with a protective put, you are buying a put option at a specific strike price. And when I say protective put and strike price, that means that you're making a bet. You are purchasing essentially insurance. For example, if the price of a stock or an ETF is $500 per share, you can then purchase a protective put option at exactly $500 per share that says, if the price of this ETF or stock goes below 500, I will not lose any value. That is what a protective put option is. And the level of protection you get is going to be dependent on where that strike price is, where that insurance is purchased. You could purchase right at the current market price. You could purchase it below the current market price. You could even purchase it higher than the current market price. Here's a quick diagram on the Option Alpha website for a protective put option. You can see here you own the stock, which means you have maximum profit is unlimited, and you also have a max loss dependent on where that strike price is. You could do it right here at the current market price, or you could do it below here, down at this price down here. Essentially, a protective put caps your losses depending on how much risk you want to take on. The higher the strike price for the protective put, the more expensive the option is going to cost. The lower and the further away from the current market price you pick, that less expensive it's going to be. Now, the second term we talked about here is a covered call. With a covered call, you own shares of a stock or ETF, and what you're doing is you're making a bet. You're saying, I want to receive some money now, and if something occurs, if the price reaches a certain point, I'm willing to sell my shares. Now, the reason why this fits into the collared option trade is it presents a cap on how much growth you have in your portfolio. You get to participate in that growth all the way up to the strike price, but any growth above and beyond that, you do not get to participate in. We're still on the Option Alpha website here. Here is that same graph for a covered call. You can see here that the max profit is defined at the strike price, and that is the end of any capital appreciation that occurs. Now, when you combine a protective put option with a covered call option, you get a collared trade. Here's that diagram right here. The red max loss is from the protective put, and the green max profit is right at wherever that covered call strike price is. The reason why this trade works so well in guaranteeing that you don't lose money and doing it at no cost, you can structure it so that the protective put option costs the same amount that you receive on the covered call. And I'm going to dive into a few examples and show you just how you can set that trade up today. First though, there might be some concern about whether or not this trade actually works in making you whole. So really what I want to do is show you a quick live example of actual historical returns for the S&P 500 and show you just how you could have placed a protective put trade and how the value would have made you whole again. So here's a chart for the S&P 500, ticker symbol SPY. And this is a 5-year chart and it shows you what actually occurred in the S&P 500 from 2020 to 2025. I want to show you right here this time frame, right approximately here at this high, 12/2021 through right down here 12/2022. Okay, obviously there was a loss of value. So the question becomes, if you had purchased a protective put option right here, And then right down here at the end of December, you would have lost value in your portfolio if you didn't have a protective put. How exactly would the dollars worked out to make you whole again? So these are screenshots from Market Chameleon, which I have a subscription with, which shows you the historical option chains for any different stock or ETF. So I want to direct your attention to, if you purchased an option, a protective put option, back in December of 2021 on a specific date. On this specific date, the market price was $477.18 per share for the S&P 500. You can see this in this red outline right here. 475 strike price, which is the closest to that market price. And that would have cost you about, we'll call that $36.95, okay? $3,695 for every 100 shares that you own. To keep things simple, let's assume we purchased the shares for $475 per share. So if we bought 100 shares, that'd be $47,500 is our cost basis. Now, on this date in December, let's say we purchased this option right here to protect our portfolio. We didn't want to lose any money at all. That would have cost us approximately $3,695, right in between the bid and the ask. So we can see that right down here. December 27th, 2021, we purchased one 475 strike protective put. And that cost us $3,695 for the put option. Now, for example purposes, we're not going to look at how we paid for that option. I just want to show you that how the protective put option works. So then we're going to fast forward here. This is the option chain exactly 1 year later on the expiration, the date of the expiration, which was, again, 12/16/2022. That was the option chain we were looking at right here, 12/16/2022. So we're going to go fast forward to that date. Expiration date, 12/16/2022. And that same 475 strike price right here what is now valued at, we'll go $9,150, kind of in between the bid and the ask. So it definitely went up in value. So let's look down here at the transactions. The net cost we assume was $0 because we paid for this option with a covered call. Now, our protective put option went up in value from $36.95 to $91.50. So remember, this was essentially, though, a net cost of $0 because we paid for it with a covered call. So we paid out $36.95, we received $36.95, and then the option is now valued at $91.50. So a net gain in for the portfolio is $9,150. Now, let's assume we didn't have a protective put option. Let's assume right here the portfolio was valued at $47,500. Then it went down to $38,357. That would be a net loss of $9,143. That essentially shows you that this protective put option fully covered this option over here. Now, obviously, if we didn't pay for it with the covered call, then we would have only been up about, I don't know, $6,000 approximately, $5,500, $6,000. So the covered call makes it so that it fully covers your portfolio and the transaction costs of the protective put option. Okay, so we know that the protective put option works, and we know that we have the potential to pay for that option with a covered call. So let's look at some real live examples today, here in 2025, of how you can set this up for the rest of 2025. All right, I'm gonna look at an example for the S&P 500, and we'll look at the NASDAQ 100. Currently, the S&P 500 SPY is costs $609.41. That's what it's trading at right now today. Now, let's look at the option chain. We're going to scroll down here to December 31st, 2025, which is 320 days, the rest of this calendar year. So if the market is currently trading at 610.55, let's scroll down here. Let's go to that price right there. Let's assume, first off, we want to have full protection at the current market price, meaning we don't lose any money at all. Right, we'll go 610, just to make it very simple and straightforward, okay? So the call option is on the left, put options on the right. Okay, so our put option costs us $2,770. So the next thing we need to do is make sure we can find a covered call that we can sell for at least $2,770 if we want to have it cost us $0 in total. So let's look on the option chain here. So remember, we sold our put or bought our put option for $2,770. We need to find that option that costs about this, or we can sell for about the same. So right about here. So we're kind of in between values. So we could go to 640. Or we could go to 635. Now, 640, we don't fully cover the cost, but this one is a little bit more. So let's assume that this is really close here, okay? This is gonna be $2,600 and about $65. So it's gonna cost us about, I don't know, $100 to do this. We could show the option value where we did 635, but 640 allows more potential market growth. So now, $105 cost to us to put on this trade. So fast forward a year, if the market is anywhere below $610 per share, then whether it's, 605, 550, 500, doesn't matter, we are fully protected because that put option that started at $27.70 is going to go up in value significantly. Now, the call option presents a cap on growth for us. So what it means is if the market, instead of going down in value, actually goes up in value this year, then the portfolio protection doesn't add any value for us because we don't know what the future holds, and we had to pay for it regardless. So the 610 put option, then we have the 640 call option. So that caps our growth. So then what that means is, let me just show you how much growth we could potentially have. If the market goes up to 640, that's a perfect scenario for us. But if it goes to 645, 650, that extra growth above and beyond 640 per share, we don't get to participate in. What that means is we have a guarantee of not losing money for the year. And we also have some potential for growth. Now, how much percentage growth do we get? So let's just figure that out mathematically here. Take 640 minus 610, okay, equals $30 per share growth. And then we take $30 per share divided by 610, which is where the market started, which equals growth of approximately 4.92%. Now, that's not a lot of percentage growth, but what we do get to do with this is we guarantee no losses, and that can add a lot of value depending on your situation. Now, obviously, if the market goes up 20%, then you're thinking, man, I missed out on some growth. And you did, but you also had peace of mind. Now remember, this put option cost so much money because we were right at the money, but let's say the real goal of the protective put option is just to avoid major market meltdowns of say 40%, 30%. So let's say we're okay with any given year we lose 5%. Okay, market go down up to 5%. Anything beyond that, we're protected. So let's see how that example would look. And again, this was the S&P 500. So instead of going with the 610 put option, we would be allowed to go down 5%. So $580 per share would be the max it could go down. So we'll go 580 put option cost right here. So this option is going to be less expensive. Instead of $27.70, this one's going to be about, we'll call it $19.77, $1,977 cost. We're going to see how much further out of the money we can go on our cap, which is going to allow us to grow potentially more if growth occurs. This one almost fully pays for, but this one's, it's going to be too much of a credit here. So we'll go right here. That's going to be the 655 call. And we're going to collect here about, we'll call it 1920 just for round numbers. Net cost is what? $57, I think. What this means is if the market goes down significantly, we have a cap starting at a 5% loss for the year, which would be about $5.80 per share. Now, what if the market goes up in value? How much of that growth do we get to participate in? 655 minus the current price, 610, which is where we started. That's $45 of growth. Divide that by 610. Now we get to participate in up to 7.38% growth, which is a lot better. And the further and further you go with that put option, the more and more up you can go at no cost, and that gives you more room to grow. Now, this is the S&P 500, which has a little bit less volatility than the NASDAQ 100. So let's look at the same thing, but with the NASDAQ 100, ticker symbol QQQ. We're looking at the December 31st, 2025 option chain, and the current market price is 538, so let's go there, 538 right here. So now if we wanted to get a full account protection here, let's assume we owned exactly 100 shares, because by the way, all these option contracts are assuming 100 shares. So for every 100 shares, you need to put on one of these trades. If you owned 500 shares, you would need to do 5 call options and 5 put options to get full portfolio protection. So let's assume here, again, 538, we want to go exactly protect the whole thing. So if we go with the 538 put option cost, right, that's going to be about, right here, $32.40, about $3,240. Now, we need to find the equivalent option on the other side. Okay, so that's going to be $32.40. Scroll down, right here-ish. It's going to be a little bit of a credit for us. Actually, right here is perfect. So that's the $569 right here. Call option sold, $32.45. So it's almost a perfect example here, $32.45. So we received $5 to put on this trade. Okay, now net cost, net credit, meaning money to us, $5. Now, what that means is if the market drops between now and the end of 2025, December 31st, you are fully protected. Anywhere below 538, you're protected. But as a result, there's a cap on how much we get to participate in market growth if we want it to be fully zero cost to us. So let's assume here, let's see what that max cap is. All right, we're going to take 569. We're going to subtract the starting price, 538. Okay, the difference there is $31. Okay, 31 divided by the price when we started, 538. 5.76% growth. Okay, now that's better than what we saw up here with the S&P 500, right? 4.92% with the at-the-money protection versus 5.76% growth right here. So let's try another example and say it's okay with us if we lose 5% of our value any given year. So we're going to place our protective put option at 5% below the current market price. We'll just take 538 times 0.95, and that gets us a strike price of $511. Now, let's see if we actually have $511 or if it's going to be a $5 increments here. 511, we do have 511. Okay, 511 is going to be our put option cost, maybe about $23.75 approximately, $23.75. Okay, so then the question becomes, how far out of the money can we go on our covered call now? Now it's kind of in between here, so let's go with this one right here. It'll cost us about $100, so this is going to be about $2,300. We'll call it $2,300. That's going to be at the 590 strike price. Okay, 590 call option sold. That'll cost us exactly $2,300. So net cost to us is equal to $75. Okay, now how much growth do we get to participate in now? So we're gonna take the difference, right, between the market cap and the current market cost. So that's gonna be 590 minus 538. That's $52 potentially of growth per share. We take that $52 in growth divided by the starting amount, our cost basis of 538, that equals 9.66% growth potential. So if it goes above and beyond 590, we get to participate essentially in 9.66% growth for that year. Now the market could go up 20, 25, 30%, or it could go up, 7 or 8%, but we get to participate up to, but not any more than, 9.66% growth. So guys, the strategy does work, but there are pros and cons, right? With this protection we have, it comes great peace of mind, depending on where we're at in life and where we're at with investing in our risk tolerance. But at the same time, it gives us a cap that we have to abide by of growth, right? We don't get to participate more than 4, 5, 7, 9%. So is this ideal for younger investors who are still in the capital accumulation phase, maybe in your teenage years, 20s, 30s, even 40s? Doesn't make a lot of sense to do, except for maybe if you had a large windfall or you had an inheritance where you have a large sum of money now and you want to protect it and grow just at a very stable amount. So then maybe this might make sense for you. But other than that though, this makes a lot more sense for somebody who is approaching retirement, really wants to avoid a big COVID year or, kind of like the 08 housing crisis when markets dropped 40, 50% and you started having to take money out of your account, and that dramatically changes the rest of your retirement. This instead makes a lot of sense for you if you're at that stage where you can say, hey, I'm going to be creating income with my portfolio with a certain segment over here, and I want to make sure that my growth portfolio is protected and growing still moderately with the markets. Then it makes a lot more sense. And of course, you can structure these trades however you want to, and you don't have to manage them at all during the year. You can just set it in the end of December or January, and then you're good through the end of December or wherever you make that expiration. If you want to learn more about this strategy, or if you want to learn more about how you can utilize options in your account to create income and add protection to your account, check out the Average Joe Investor Patreon community. There's a ton of value there, access to all my spreadsheets, and access to an amazing DIY investor community. If you want to learn more, check out the link down in the description below. Also, please make sure to leave your 2 cents down in the comments below. Let me know what you thought about this video, any feedback, recommendations for future videos, etc. I try to respond to as many comments as possible on the day I post a new video. That's all I got for you guys. Have a great rest of your day, and thanks for watching.